Welcome to this video, where we'll be discussing the three fundamental stock order types: market orders, limit orders, and stop orders. Understanding these order types is crucial for any trader or investor who wants to effectively manage their positions. In this video, we'll dive into the details of each order type, explore their pros and cons, and provide real-life examples to help you understand how they work in practice. Whether you're a beginner or an experienced trader, this video will provide you with an understanding of the three stock order types and help you choose the right one for your trading strategy. If you like this content, please remember to hit the like button and subscribe. Sit back, grab a notebook, and let's get started. A stock order is a request that you provide to your stockbroker or online brokerage system to buy or sell shares at a specified price and quantity. There are several different types of stock orders that traders and investors can use to manage their positions and execute trades. Some of the most common ones include market order, which is an instruction to buy or sell a stock immediately at the best available price. Market orders are typically used when the trader wants to execute a trade quickly, without worrying about the exact price they pay or receive. Limit order, which is an instruction to buy or sell a stock at a specified price or better. Limit orders allow traders to set a specific price at which they are willing to buy or sell the stock, and the trade will only be executed if the stock reaches that price or better. Stop order, also known as a stop-loss order, which is an instruction to buy or sell a stock when the price reaches a specified level. Stop orders are used to limit losses in a trade and are typically placed below the current market price for a short position or above the current market price for a long position. Understanding stock order types is important for traders and investors for several reasons. Better trade execution. By choosing the right type of stock order, traders and investors can improve the execution of their trades and achieve their desired outcomes more effectively. For example, if a trader wants to buy a stock quickly, they may use a market order, whereas if they want to buy the stock at a specific price, they may use a limit order. Risk management. Stock orders can also be used to manage risk. For example, stop orders can be used to limit losses in a trade, and limit orders can be used to prevent paying too much for a stock. Increased control. Understanding stock order types gives traders and investors greater control over their trades. They can set specific parameters for their trades, such as the price they are willing to pay or the level at which they want to sell, giving them greater control over their positions. Improved trading strategy. By using different stock order types, traders and investors can tailor their trades to their specific needs and goals. This can help them develop and implement a more effective trading strategy. Let's now look at each of the stock order types in more detail. Market order. A market order is a type of stock order that instructs a broker to buy or sell a stock immediately at the best available price. Market orders prioritize speed of execution over the exact price at which the trade is executed. When a market order is placed, the broker will execute the trade as quickly as possible, regardless of the current market conditions. Market orders are typically used by traders and investors who want to buy or sell a stock quickly and aren't concerned about the exact price that they'll receive in return. For example, if a trader wants to sell a stock to lock in a profit, they may use a market order to ensure that the sale is executed as quickly as possible. Similarly, if an investor wants to buy a stock that is in high demand, they may use a market order to ensure that they get a piece of the action before the stock price rises further. It is important to note that market orders do not guarantee a specific price. Due to market volatility, the price at which a market order is executed is subject to change. This means that market orders can result in unexpected outcomes, particularly in fast-moving markets or in less liquid stocks. Suppose you want to buy 100 shares of Apple Inc., and the current market price is $150 per share. When you place the market order, your broker sends the order to the exchange, in this case the Nasdaq. The exchange then matches your order with the best available sell order and executes the trade, which could be $150 or higher, depending on market conditions. Let's assume that the current best ask price for Apple Inc. is $150 and the exchange matches your order. Your market order will be filled and you will now own 100 shares of Apple Inc. at a cost of $15,000 or $150 per share. However, it is also possible that the seller with the lowest asking price is not offering sufficient shares to fulfill your order. Let's say that there is a seller of 50 shares at $150.10 and another seller of 50 shares at $150.20. In this case, your market order will be filled at $150.10 and $150.20 respectively, and you will now own 100 shares of Apple Inc. at a cost of $15,015 or an average price per share of $150.15. It's important to keep in mind that market conditions can change quickly and that the execution price of a market order can be affected by various factors, such as the volume of trading in the stock, the volatility of the stock price, and the overall state of the market. Large stocks with a lot of volume of trades will generally only move slightly from the market price, but small liquid stocks with lower volume of trades will generally have a wider bid-ask spread and can move significantly from the current market price. Before placing a market order, it is wise to at least have a cursory look at the market depth. The market depth is a listing of generally the 5 to 10 bids and offers that are closest to the market price. It shows the number of buyers and sellers and the total volume at each price. If there is substantially more volume available and the bid-ask spread is narrow, then there is little risk in executing a market trade. However, if the opposite is true, then it may be more wise to enter a limit order. Pros of using market orders. Speed of execution. Market orders are executed immediately, ensuring that you will be able to buy or sell a stock as soon as possible. This is especially important in fast-moving markets where prices can change quickly. Convenience. Market orders are simple and straightforward, making them a convenient choice for many traders. You do not have to specify a specific price for your order, which can save time and effort. Guaranteed execution. When you place a market order, you are guaranteed to have your trade executed, as long as there are enough shares available for purchase. Cons of using market orders. Price uncertainty. Since market orders are filled at the best available price, there is no guarantee that you will get the price you want. This can be especially problematic in volatile markets, where prices can fluctuate rapidly. Price slippage. Slippage is the difference between the expected price of a trade and the price at which the trade is actually executed. Market orders are more likely to experience slippage, especially in illiquid markets. Lack of control. When you place a market order, you give up control over the price at which your trade is executed. This can lead to undesirable results, such as executing a trade at a price significantly higher or lower than you intended. Next, let's look at limit orders. A limit order is an order to buy or sell a stock at a specific price or better. When you place a limit order, you specify the maximum price you are willing to pay to buy, or the minimum price you are willing to accept to sell a stock. Your trade will only be executed if the stock's market price reaches the specified limit price. For example, if you want to buy 100 shares of Apple Inc., and the current market price is $150, you could place a limit order to buy 100 shares at $149. If the stock's price drops to $149 or lower, your limit order will be executed. A limit order provides more control over the price at which your trade is executed compared to a market order, but it also comes with some trade-offs. One of the main trade-offs is that a limit order may not be executed if the stock's price does not reach your specified limit price. Putting in a limit sell order is sometimes used by traders who are holding a stock and have specific profit margin in mind that they are willing to accept. By entering a limit sell order, they don't have to be watching the market movements. If the share price reaches this level, a trade will be automatically executed. Conversely, a limit buy order may be used by traders or investors who wish to buy a stock but at a better entry point than the current market price. They set a buy price below the current market price and don't have to be watching the market. If prices fall, their trade may be executed. Pros of using limit orders. Price control. Limit orders allow you to specify the maximum price you are willing to pay to buy a stock, or the minimum price you are willing to accept to sell a stock. This gives you more control over the execution price of your trade compared to a market order. Better prices. Limit orders can help you secure better prices than the current market price. For example, if you place a limit order to buy a stock at $50 when the current market price is $51, you will only be filled if the stock's price drops to $50 or lower. Reduce market impact. Limit orders can help reduce the market impact of your trade. By specifying a specific price, you reduce the chances of moving the market and potentially affecting the price of the stock you are trading. Cons of using limit orders. There is no guarantee of execution. Limit orders only get executed if the stock's price reaches your specified limit price. If the stock's price does not reach your limit price, your order may not be filled, and you may miss out on a potential trade opportunity. Lack of flexibility. Limit orders are less flexible than market orders, as they require the stock's price to reach a specific level before they can be executed. This can be problematic in fast-moving markets, where prices can fluctuate rapidly. Finally, let's look at the stop order. A stop order, also known as a stop-loss order, is a type of order that is placed with a broker to buy or sell a stock when it reaches a specified price, known as the stop price. The stop price acts as a trigger that activates the order and executes the trade when the price of the security reaches or surpasses the stop price. In this case, you are effectively entering into a market order once the share prices reach this threshold. As with market orders, the actual execution price can differ widely from the market price, depending on the liquidity of the stock and market conditions. For example, suppose an investor owns 100 shares of Apple Inc., purchased at $150 per share. They want to limit their potential losses if the stock price drops significantly, so they place a sell stop order at $140 per share. If the price of Apple's stock drops to $140 or lower, their stop order will be triggered, and the stock will be sold at the current market price. Stop orders can be used as a risk management tool to limit potential losses. It's important to note that stop orders do not guarantee a specific price for a trade, as the actual price at which the trade is executed will depend on market conditions at the time the stop price is reached. In the last example, if the highest bid price is at $130, then the trade will be executed at $130 rather than the stop price level of $140. Pros of using stop orders. Risk management. Stop orders can help manage risk by allowing investors to set a predetermined limit on their potential losses. By automatically triggering a sale when a stock falls to a certain price, stop orders can help prevent further losses. Automation. Stop orders take emotion out of the trading process, as they automatically execute the trade once the stop price is reached. This can help prevent investors from making impulsive decisions based on fear or greed. Flexibility. Stop orders can be used to lock in profits as well as limit losses. By setting a stop price at a level that is higher than the current market price, an investor can automatically sell the security and lock in profits if the price rises. Cons of using stop orders. Price slippage. When a stop order is triggered, it is executed at the current market price, which may be different from the stop price. This is known as slippage, and it can result in a lower price for the trade, potentially reducing the investor's profits. Volatility. Stop orders can be subject to significant market volatility, particularly in fast-moving or high-volume markets. This can result in stop orders being triggered at prices that are much different from the intended stop price, potentially resulting in larger losses or reduced profits. In summary, choosing the right stock order type will depend on your investment goals, market conditions, time horizon, risk tolerance, and trading fees. It's important to carefully consider each of these factors and understand the potential consequences of each order type before making a decision. And this brings us to the end of our video on stock order types. We hope you found this information helpful. By understanding the different types of stock orders and how to balance risk and reward, you can make informed decisions and increase your chances of success. Thanks for watching, and happy trading.